I don't know whether this has longer-term effects or whether you take 2011 as a template and say, look, there's no real alternative, the US is not going to default, it doesn't really change that much.
Yeah. I think when we analyze this type of downgrade, at least from a short-term perspective, we think about, is there anybody who has to sell anything as a function of this change? And I think in 2011, that would have been the case. There were entities that could only hold AAA assets, or they had to give AAA assets as collateral. But that has really changed in that period since. We tried to do the numbers again last night. Like, it's very hard to find funds, entities that are excluded from other stuff than AAA. So I don't think there's going to be a lot of forced selling, right? So the question is there some kind of sentiment shift that's going to happen as a function of that? Clearly, it's not good news. No. But if we look at the initial market reaction, pretty moderate reaction in the bond market, pretty moderate reaction in the currency market and in the equity market. But the equity market was perhaps already starting to be a little bit shaky before this news come out, and maybe that's continuing to.
But yeah, so there's 102 billion coming up for issuance in the next 10 days.
Yeah.
Does that change appetite?
So I think the problem with the U.S. bond market is that even before this news, we had a kind of flow situation that was starting to look pretty shaky. Japan have their own kind of bond issues. They've stopped buying U.S. bonds over the last 3 weeks. Bond funds in the U.S., we track them one by one. They've already been buying a lot of bonds over the 9 months, and they kind of probably have more limited capacity to really add to that. So what we've seen over the last couple of weeks is that in the absence of any bad news, yields are drifting higher. And we've even seen that in the last couple of days. Now we have the funding announcement coming later today, right, where a lot of bonds are going to be issued. So it was already shaking, and clearly the news we've had today is not going to make appetite for buying U.S. bonds particularly strong.
But so, yeah, where's the biggest mispricing when it comes to global rates market?
Well, so I think after we had the U.S. CPI print that got everybody excited that maybe the Fed can start to relax a little bit, we started to price very aggressive rate cuts. If we look at 2024, we had 150 basis points priced. That's not really what the signals from the economy are showing, right? Okay, maybe headline inflation is coming down. Labor market still looks very robust. Every time I speak to CEOs or something like that are hiring in the U.S., they always tell me the labor market is tight, right? So it's hard to see the Fed being forced to cut rates aggressively unless, financial conditions take a big turn down.
So what cuts are for 2025?
Yeah, I think that's a long time frame. Over that time frame, right, what is happening over time is that more and more people who have to borrow are rolling into these higher rates, but it doesn't happen from one day to the other.
But so if you look, so let's talk about the Fed just stopping hiking, right, not talking about cutting. What are the currencies that benefit and lose the most just from that immediate effect?
So what we've seen over the last couple of months is that it really depends a lot on what risk sentiment is, right? So you can do kind of emerging market currencies. Emerging market currencies actually had a really great run during this period where the U.S. equity market was doing very well. So we talk about the strong dollar, but actually LATAM currencies were even stronger. And then in those periods where the equity market turned, you have the yen and the Swiss franc. So it really depends a lot on what risk assets are doing. And that's what we've seen over the last couple of months.
So going back to BOJ, what's the biggest impact actually of that shift?
Well, I think we actually get data today on what is the weekly flow in and out of Japan, right? And as I mentioned earlier, we've already seen over the last 3 weeks that Japanese investors are not putting money into the U.S. bond market anymore. And Japanese fixed income investors are very important in global fixed income markets and the U.S. market, right? So if they stop that because they now have higher yields domestically, that, I think, is an issue if the U.S. bond market is already looking a bit shaky. So I think that's something to watch very closely.
Do you think that actually the end of yield curve control is a given? And by when?
So I think effectively the yield curve control is already dead. Okay. So now it's just a transition phase where they smooth the transition to a new regime. But I think it's already been abandoned. It's the right decision, right? And now it's just a matter of how quickly do they allow the yield curve to actually adjust to that new reality.
Are you, I mean, this is a question that we could talk about for like 5 hours, right? If you look at inflation, how are you are you sure that central banks are not getting it wrong again? Inflation doesn't spike back up.
I have a lot of clients that crunch CPI numbers in intense detail, and I think amongst the ones that really go into the detail, there's sort of a consensus that the next couple of prints are going to look okay.
Yeah.
And then when we get to Q4, the numbers are going to be higher again. That's another argument that it's going to be hard for the Fed to actually cut in 2024.
But what does that tell us? Like, it's unclear. I mean, these patterns, is it because of COVID? Is it a tight labor market? Is it structural forces that we don't understand?
I think when you look at what's going on with inflation globally, we don't have goods price inflation anymore. Over the last 4 or 5 months, we've essentially had goods prices flat. Not just a 2% inflation target, but below. So that problem has kind of gone away. And the remaining problem is wages still going up more than is consistent with target, and the services prices following. But that also depends on which country you're looking at, right? So those economies where the services sector is big are going to facing that problem. The other economies where that's less of the basket and perhaps they're more linked to China actually have a different inflation dynamic now.
But so you're expecting, I mean, this is worrying, right? Because you could have a situation where inflation's picking up again, but actually interest rate hikes are starting to have an impact on the economy.
It's not easy to be a central banker, right? Because of the...
or a market participant, frankly.
No, you could say that too. Yeah, the central banks have like a real tension between inflation that is still way above target on services, right? And then growth starting to turn. In the last 15 years, we have been used to a regime where as soon as growth turns, we got easy policy, right? And I think this is the real tricky bit. It's the same for the ECB, right? A lot of people are looking at the PMIs turning over, but I don't think it's going to be so easy for the ECB to stop if core inflation is still printing way, way above target.
We talked a bit about the BOJ policy shift, yield curve control, talked about inflation and treasury. When you look at real yields, are they sufficiently restrictive in both the US and Europe, or do they still have further to go?
So I think this year, like if I was going to say one key word for the whole year, it's credit, right? So I spent a lot of time on looking at credit dynamics globally, and we can see credit dynamics are slowing quite dramatically in Europe. ECB has commented on that as well. In the US, credit dynamics are slowing, but I think people are a little bit surprised that they're not slowing faster because they thought there was going to be a massive shock from Silicon Valley Bank. To finish off with Bank of Japan, they're actually seeing the opposite. Credit growth is quite strong in Japan, which fits with their real rates not being high, right? So monetary policy matters, and you can see it in the credit dynamics around the world.
What's your biggest worry about Europe? So I know you mentioned PMIs that could be a little bit wobbly going into next year, but we're also seeing, I guess, spending not having such a easy trajectory that maybe some economists had thought.
Yeah, I think the concern for the economic outlook is often linked to what's going on in the labor market, right? So the labor market has been holding up quite well. Like when we look at hiring, we still have respectable hiring in many Eurozone countries. Unfortunately, the data comes out very slowly in Europe, so we don't have as good data as we have in the US. But I think that's what would concern me. If that weakens further, I would say, okay, we're heading into a very tough time, but it's not at that point yet.
I know you like looking at quirky charts, which is why I love following you actually on Twitter as well. If you look at income and expenditure, side estimates of U.S. output growth, and there's a paper from Brookings Institute, I don't know whether there's, a divergence, for example, that we're seeing in GDP growth and GDI growth that we need to pay attention to. Is there something that you're paying attention to which is off the beaten track that gives us a glimpse of what we should be looking out for?
Well, so I think related to essentially who makes the money, are we having increasing inequality? All those things are tied, right? So we have a situation now where there's a lot of focus on AI in the market and other places, right? And I think the concern with those accounts is that we're going into a phase where increasingly the extra value added in the economy will be derived from some very big companies, and that's going to skew the income distribution even further and not be good for demand going forward. So I think that's what to watch for in that data right now.
Are central banks aware of this? Or, I mean, is there a blind spot actually that you're seeing that could make them take a wrong decision?
I think central banks are reluctant to take strong views on these new trends until they can see clear evidence of in the data. I think there's going to be a debate about, oh, how's our star going to be impacted by this stuff, but it's too academic for them to set policy on it. To be honest, policy is going to be very much a function of what the core inflation is in the next couple of months, because they don't trust their forecast that much anymore, because they've been very wrong for 2 years now.
How difficult is it being a Bank of England official right now? So if they have a decision tomorrow, 25 or 50 basis points, it's kind of on knife edge, but it's also a lot of complexity. I mean, they even drafted Ben Bernanke in to have a look at forecasts. So
Bank of England is facing a very tough situation, right? We know the high interest rates are going to be causing serious issues for mortgage holders as those reset. But in addition to the underlying challenges, I think they've also created some challenges for themselves with, I would say, pretty erratic communication, kind of a bit stop-go with the pace of tightening. So that's going to be a tough communication. I think they're going to try to be quite hawkish, but not continue with the 50 basis points. So it's going to be a weird mix. They're going to have to, again, explain their forecast, which comes out of a model that not a lot of people have a lot of confidence in. So not an easy job they have on their hands.
I mean, talking about models, you're founding another company because you're not busy enough, looking at like algorithms and basically, what are you trying to study that you think is lacking in the market?
We're trying to solve a very simple problem that essentially everybody in the market has. We want to understand, why is the market moving? Markets are complex, right? So it's not such an easy thing to answer all the time. So we want to attack that with a lot of data across a lot of different dimensions and really give people an objective, real-time answer to why we have gaps in the markets for stocks, macro assets, and so forth.
And you think, is there more of a gap with what markets are doing than what the economy is doing? Because the economy, I mean, we've read the economy wrong on multiple occasions for multiple years.
Well, so in the new company that we're launching called Market Reader, our focus is to give objective explanations of what is happening. That could be tied to economics, it could be tied to something else. Anything that we think is relevant will be surfaced.